let's do a quick overview of the regime we are currently in and take a look at the opportunities that we might currently have. Essentially, the trades that we've already put on just this week, actually, after NVIDIA earnings came out. One thing in particular I want to point out is high yield and insensitivity and complete break in correlation on a trending basis between high yield, the credit. Sure, HYG ETF is not the pure representation of, and not total representation of the whole high yield universe. That's pretty obvious, but it's good enough for our purposes. And HYG is a big constituent and contributor to our overall model of cross-asset class analysis, to gauging and understanding what's the environment we're currently in. And HYG, high yield ETF, decoupled from DXY, decoupled from short and long end in the US, overall from the rate sensitivity complex on a trending basis completely. And when that happens, when high yield, the most sensitive thing, that is supposed to be the most sensitive thing to the rate sensitivity complex, decoupling from into the positive side, meaning this is as positive signal as you can possibly get in the model for the risk-on environment. And this is what's currently going on. It's not to say that we are expecting a significant repricing in credit higher. We don't trade credit, but the fact that we've been calling for high yield to stay in a consolidation and the correlation to fade away in between equities in rate and rate sensitivity complex, and to say that we've been expecting any negative catalysts on the macro front that are impacting rate sensitivity significantly, like the recent CPI reports, FOMC meetings, and we've been saying that it is unlikely to impact the equities and the indices significantly on a trending basis. Rather, we might see a episodic, non-trending spikes in volatility across equity, meaning this your inflation reports, FOMC meetings, and this is what you're getting, and that's it. So far, this has been it. What we've underestimated is how resilient the HYG will remain in the face of a obvious bullish trend in the short end, an obvious bullish trend in the long end of the curve, and in Dixie as well, in currencies as well, because the dollar, even though it is currently testing the trade support, is still bullish trend. So it's not the time to be short or long the dollar. We are leaning towards the long, but not the trade you want to be in currently, because the game right now, the concentration where you want to put your money in is in equities, obviously. And this is the thing to highlight. So we are currently in this reflationary slash Goldilocks regime, which is very positive in and of itself for the risk taking, any kind of risk taking. One thing to point in particular is the potential risks that we think is upon us that can materialize. Is we are getting a bunch of inflation data before the next FOMC meeting, which is on 20th of March. We're getting PC next week on 29th of February, and then we're getting another round of inflation prints on 12th and on 15th, 14th of March as well. So we're getting a bunch of inflation data before the next FOMC. And during the next FOMC, we will get the new dot plot projections. And this, depending on how inflation comes in, might finally be a catalyst for equities to chill out for a little bit on a trading basis to get some sort of a meaningful correction. Meaningful meaning maybe 2, 3, 4, 5%. We don't know what the correction might be, but this might be perceived as a negative catalyst, which might send dollar into 106, which might send yields higher. Maybe we are pricing out the, if dot plots, let's say, project the median projection 75, maybe it's going to be 50. Depending obviously as how inflation data comes in. But this is definitely one of the most significant catalysts that can shift the rate sensitivity complex significantly higher or significantly lower. Is no, it's probably not going to shift us significantly lower, but maybe it can potentially take the long end higher, short end higher, and Dixie higher as well. And this might be negative for beta overall. This might cause a beta weakness. We still have ways to go. Obviously, it's 20th of March, plus inflation data is on 12th of March. We get in PCE. We don't know how impactful PCE is going to be. It is a very impactful and meaningful metric that Fed said they are looking most closely at, but we shall see. This is the risk. This is the current risk. But nonetheless, putting this all aside, we still have some room to run in reflation trade in equities across broad indices and mostly in AI related stuff. And if you look at the AI related stuff, I'm looking at NVIDIA itself. Where's my NVIDIA? Yeah, it is. Do not underestimate how crazy it might get. This was, as we've said to our clients at the beginning of this week, the fact that we're seeing this degrossing into the major event within the overall incredibly positive environment like reflation and Goldilocks. And if we are getting good earnings, and earnings are, it's most likely it was plenty obvious that Nvidia was going to beat. It's just a question by how much, and they did beat. And the fact that you've received this opportunity to get in, just by this move lower, there were plenty of opportunities skewed to the upside anyway. You could have put on trades in Nvidia. We got long Nvidia after hours when earnings came in on a trading basis, just as a trade. And we think before the 20th, before the 12th of March, this might be a potential beginning of a blow-off top move, meaning can we see Nvidia at 1,000, at beyond the 1,000? Absolutely. Why not? We shall see whether this is going to happen or not. But the environment is positive. But Nvidia is not the play right now. If you want to play anything in AI space, obviously Nvidia is the train has already gone. There are things like connectivity providers. Marvell. We do like Marvell very much so. The signal is unbelievably positive, bullish. From the signal perspective, from the bottom up, we very like where the Marvell stands right now, and we think earnings might come in pretty good, and earnings once again coming out on 7th of March. This is before the next bunch of next load of the CPI data, so the beta should remain strong coming into the Marvell earnings. The Nvidia should remain bid coming into the Marvell earnings, and what we'd like to see is Marvell testing 72 and staying below 72, even breaking 72, going higher before the earnings. And there's a high probability that we think Marvell is going to surprise to the upside, and we are poised to maybe retest all-time highs on Marvell. AVGO is a company that is engaged in the same thing as Marvell, and whether this is expensive or not, we don't think, we don't operate on this basis, but we do not like how overextended it is, and we shall see how it's going to behave going into the earnings. But once again, earnings will be good, undeniably will be good, and we shall see whether we're going to put anything in AVGO as well. But Marvell is a thing to be in, and Micron is other thing we like very much so. The problem with Micron is the earnings are set to come out on 20th of March, which is pretty far away from where we currently stand, and exactly the 20th of March is the heart of what we think might be a potentially negative catalyst for beta. And well, we shall see how Marvell going to behave in that in that environment before the earnings. What we did with Marvell and MU, we after hours when Nvidia reported, and it was obviously a beat, we put on spot positions, long spot positions in MU and Marvell, full size immediately after Nvidia reported. We got in at 82.50, if I'm not mistaken, on Micron, and what is it, 60 67 on Marvel as well, and spot position. We coupled this with 85 call spreads for 20th or 15th of March for Marvel, and which are paying, if I'm not mistaken, 1 to 6 risk reward, something like this, and 95 100 call spreads as well for 21st of March for MU, which is paying 1 to 6 or 1 to 7 as well, if I'm not mistaken, for $64. These are the places we're currently in from the in AI sphere, in AI region. The other thing we like is CN Corporation. Same thing. We don't know how we're going to play this one yet, because the history of its reporting and the way it reacts to earnings, you can see that, Jesus Christ, we are moving. We can move 15% gap higher, lower easily. We believe we're in a new regime for names like CN, Coherent, Creda Corporation. They will be beating earnings. Just if you listen to Nvidia, if you listen to other connectivity providers and other competitors and names in this field, the outlook is unbelievably positive, And where we currently stand in CN is we've broken out of this significant range that we've been in for months and months, for years on end, and significant move on a beat higher from here even into 70s, as within the environment which is so positive as it is now. Wouldn't surprise me at all. We've been looking at Oracle, Adobe as well. They have a couple of names of interest. Snow as well is interesting, but these are the main plays. Obviously, you should have been in TSM and Nvidia from the beginning, from the 1st of January, as we've been saying and writing that Nvidia is our biggest position after we broke out of this consolidationary half-a-year consolidation that we've been in, and we think we were going into the positive Goldilocks/reflation environment. Yeah, this is it. Things like ASML, TSM, I would not be selling them right now. No. I would be holding until we get a significant, clear confirmation on that negative side. Is there other things that we look at? Well, no, not really. In AI space, we tend to be very concentrated. We tend to find things that we like the most and just go hard on them. The trade that we highlighted, yes, obviously you should have bought Nvidia on the good report after hours, or put on. We were thinking, but we didn't do this, unfortunately, of putting on 745, 750 call spread. It was paying 1 to 4, 1 to 3 risk reward. We didn't like that much. What we missed is because we thought essentially this would happen. We didn't know to the extent of the beat, what the beat would be, and how strong the reaction was going to be. But we knew the reaction was going to be very good, and the likelihood that this wasn't the top for Nvidia was very, 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 very strong. What we missed is I just completely missed it, unfortunately, this week, is when we were trading before the earnings. I was thinking of putting just buying out of the money calls, weekly calls, February 23, 503, 504 calls. These essentially paid you 1 to 7, 1 to 8 risk reward. Just didn't put this on, unfortunately. But this the environment. This is I've just described the potential risk that is on the horizon, which is not that far away. By the way, the thing, how we think of playing the potential beta weakness is with Apple. If that is, Apple has been a good funding short throughout this year already, compared to everything else. Meaning everything else from the big boys, that is, and from AI space. If you think we are getting not now, definitely not this week, and probably not next week, but closer to those inflation prints, closer to the maybe end of March, we are going to get some relative beta weakness, and maybe we're finally going to get this, because if realized volatility is expanding as it is right now, if you look at Nvidia, if you look at SPY, right, the higher we go up, the stronger the impulse up, the stronger will be the impulse down. So they'll realize volatility is increasing, and can continue to increase and increase. And to get some sort of once again 2, 3, 4, 5, 6% negative move in SPY and weakness in beta is not unheard of. Is At some point it will be expected. We should expect this. From the perspective of potential timing, we think from the 20th to the end of March, this might be a window of weakness. And if that is, you want to play anything on the short side, is Apple. Apple looks gorgeous on a short side. The relative underperformance, the negative trade. So far, it hasn't broken the into the positive trade territory, but negative trend, negative trade. And if we're getting this potential weakness, we will observe Apple on the trending and trading basis and intraday basis as well, if there are any significant signals. And what we like about Apple is the put skew. Not an incredibly significant put skew, not record put skew, but nonetheless it is there. And just right now you can put like 1 to 6, 1 to 7, 1 to 8 risk reward put spreads on, like 175, 170 on Apple, to potentially hedge this base of weakness whilst holding your AI longs. From the long short perspective, this looks reasonable. The other thing is Tesla as well. Has been and will continue to remain weak, undeniably. And once again, if we are getting the beta weakness, just look how Tesla is behaving in the face of an incredibly strong run-up in just across the board, across the equity, whole equity space. And this is what you're getting in Tesla. When we're going to get the signal, we believe if we are getting this beta weakness, Tesla can easily retest 150, easily. So this is the idea. This is how we're thinking of playing it. And yeah, the market just opened. Let's look at CVNA. It's going to sell off probably hard since on the open. The guide was incredible. Overall, a pretty favorable scenario for CVNA. Let's look at the PNL. We had a 65.70 call spread, 15th of March. Let's see how it plays out. Okay, thank you. How do I turn this off?